The prospect of a dominant Trump presidency is significantly more likely than it was only a week ago. But what does that mean for shipping? Will the anticipated Trump trade really result in more inflation, higher interest rates, and sweeping tariffs? Will the inevitable bonfire of Biden's environmental rules put the brakes on shipping's already hesitant energy transition? And what about the all-important relationships with China and Europe? What does that mean for free trade? Are we entering a period of protectionism? Well, political risk is notoriously difficult for markets to price in, and if this week has taught us anything, it's that there are very few certainties out there when it comes to US politics generally right now, and Donald Trump specifically. But with Trump 2.0 now looking increasingly like the base case scenario for businesses to plan for, we take a deep dive on the podcast this week into what a second term of Trump would look like for the maritime markets. Our senior US reporter, Greg Miller, takes the reins this week and starts by talking to Jason Miller, a freight economist and professor of supply chain management at Michigan State University.
Hey, Jason. Thanks for joining us. Always good to talk.
Always great. Thanks for having me on.
Yeah, so always a lot going on in container shipping, and on top of everything else we got going right now, presidential election, strong possibility of a second term for Trump. Think back to the first time around, significant tariffs, huge trade war with China. There was a noticeable effect on import timing and rates. I mean, if I looked at the index charts at that time, I could clearly see the spot rates were above normal in the second half of 2018 as the importers raced to bring in the goods before the tariff deadlines, and then weaker in 2019 due to the overhang. And here we are again. During this campaign, Trump has proposed 60% tariff on all imports from China, 10% tariff from other countries. So first question to you, Jason. Trump's not in office yet. He's favored to win, particularly so after the assassination attempt. He's not there yet. But even so, do you think that U.S. importers, particularly those with significant exposure to China, should be thinking about this right now, about Trump tariffs? And are we at the point where this becomes a major part of strategic thinking for logistics managers?
No, certainly it's something that needs to be top of mind in terms of planning strategy in 2025. I mean, the way I would tell anybody right now is you plan for three scenarios. You plan for a second Biden administration, a Trump administration with a reduced emphasis on tariffs, and then I'm going to say a Trump administration with the, quote unquote, tariff king approach, which is the 60% China tariff, 10% global tariff. And you essentially start building your strategy around those three potential scenarios.
So let's look back to 2018-19, the initial Trump tariffs. It's clear that the strategy at that time was pull imports forward. So let's assume that Trump wins. And let's assume that the tariffs go into force, let's say January 1st, 2026. How significant of an effect could this have on the container shipping market in 2025 in terms of volumes and rates, and why? And I mean, how extreme could this be?
So I expect that if we would see the extreme 60% China tariff and 10% global tariff, this will be a much greater pull forward than what we observed in 2018, simply because we're looking at a much higher dollar figure involved. A lot of this will depend on timing of tariffs. So in other words, if they were going to go in place in 1 or 2 months, there's really not much you can do, versus if you have, let's say, a January 1, 2026 start date, then you allow much more time for that pull forward. So without knowing the exact timing, it does become a little hard to speculate. But when you think about it, the rough rule of thumb has always been $50,000 of goods per TEU. That translates to $100,000 per FEU. With a 60% tariff on that, well, you can start to see essentially, $20,000, $30,000 spot rates are actually an economical play versus paying, $60,000 of tariffs. So you would certainly expect a, big essential increase in surge imports. And it's important to remember, and I'll give a shout out to one of my former doctoral students who's done some research on this. A lot of what we could move out of China has already been moved out by 2023. So it's going to be difficult essentially to relocate sourcing for a lot of things that are still coming from China. It's going to be very hard to shift and reallocate those. And so it's not like there's the degree of sort of fungible shifting that we saw back in 2019, where there were a lot of things that could be reallocated to Vietnam or Mexico. The amount that can still be reallocated is rapidly dwindling.
In terms of pulling imports forward to get ahead of the tariffs, I mean, obviously, not everything can be pulled forward. Some things are time sensitive. What do you see as the kind of goods that importers could bring forward and sort of avert the tariff? And what are the kind of imports that just really have no choice but to pay?
Yeah, so for example, highly seasonal imports, I mean, you can't bring in Christmas stuff before you bring in, spring goods that are expected to sell. So you have, for the big retailers, there are some limitations for this because there's just simply storage capacity limits. So you've got your regular back to school season, you've got your regular Christmas season. It's hard to pull, let's say, both, one forward at the same time as the other because you're just simply going to run out of space. For things that are more fungible, so let's say, general plastic components that can be melted down and shaped into other items, those are the type of things that we can, work with, or some building materials, things that are flexible in that regard, can be pulled forward. You can't really pull forward tech products that much because they lose value too quickly. Apparel and clothing is hard to pull forward from a standpoint of, again, highly seasonal. We don't know what tastes are necessarily going to be. And so in a lot of these cases, it's just going to fundamentally be, you will have some pull forward, but in many cases, importers are just going to be stuck eating these much higher costs than they would have before.
And you mentioned the supply chain diversification before, which has obviously been a major trend for years now. That's not something that can be done quickly. If you're looking at, the political issues now and the possibility of a second Trump term, just as supply chain managers may be looking at timing of imports, do you think that they're also looking at, further supply chain diversification, given the fact that you said that there's only so much further they can go?
Yeah, so I think it's still, we're still seeing some reallocation, but a lot of what could be shifted out of China already has. And, we see that in things like cell phones, where China's not, accounting for nearly the share of smartphone shipments today as what they would have back in 2017 or 2018. So we have seen that, but it just, there's not that many locations you can start to shift to. I mean, you've got obviously Vietnam, but Vietnam has had such an increase of exports to the U.S., you wonder how much more capacity there is there. You have India, Malaysia, Indonesia, Mexico. Turkey is actually another beneficiary of that, though Turkey has a major inflationary crisis going on right now. So you have a little bit of, flexibility to reallocate some more, but there are some inherent limits on this. And especially even as importers, if you consolidate multiple suppliers' shipments into 40-foot containers before shipping to the U.S., the more you diversify, the higher you end up paying for transportation because you lose those consolidation possibilities by shifting out of China. And we're also finding for many product categories, China's the best-in-class producer, especially textiles, certain high-end garments. Factories in Central America cannot provide the same quality that they can in China. So we've had some companies shift and then have to shift back to China. I don't see much manufacturing shifting here to the United States because, quite frankly, if you offshored it for labor price issues back around 2000, you're not going to come back to a high-cost manufacturing country like the United States. It just doesn't make sense.
Yeah, and there's also a difference between the situation now, particularly with regards to the U.S. economy, versus during the Trump presidency. So if you think back to then, inflation wasn't that much of a factor. I mean, that was before the pandemic. And now it's inflation. Looking at the Fed easing, the Fed timetable. How inflationary do you think that some of these tariff proposals could be? I mean, particularly given in light of the fact that it's not just the tariffs, you also have the immigration controls that could affect labor availability. You have the tax proposals. I mean, and how could this sort of inflation factor hamstring the ability for Trump to put the most extreme tariff scenario in there? In other words, maybe he can't do what he's talking about.
Yeah, so I think the one, estimate I've seen is that the full tariff proposals would represent about a $1,700 tax essentially on the average U.S. household. So that would, certainly have a a little bit of demand destruction, and or it's going to just mean higher prices for a lot of goods, especially, again, things like apparel, smartphones, etc. It's a little hard to say. I mean, the Fed is in a position now. I would argue they could lower interest rates here in July with no issue, given where things are at right now from an inflation standpoint. It's kind of hard to tell because we don't know necessarily where energy prices are going to go. I think that this belief that more oil drilling will somehow lower the price of oil is, I think, a little misplaced, because a lot of this comes down just to the infrastructure to support more drilling, and quite frankly, refining capacity in the U.S. is tapped out right now, and we lost almost 10% of that with COVID's onset, and those refiners aren't coming back. So I don't see much of any type of, energy price easing. It's kind of hard to say until we start to see what the data itself would look like. My guess is a lot of businesses will incredibly strongly lobby, Trump administration not to put this type of tariffs in place. Where I see the biggest challenge is going to be the ultimate demand destruction for domestic manufacturers because of retaliatory tariffs. Because the U.S. is very competitive in certain export industries, and these aren't secret industries. You can go access what they are through the Census Bureau. And so we'll see our, other countries will retaliate very strategically. So I can tell you right now, China will put massive retaliatory tariffs on soybeans, other agricultural products, the pulp paper. So pulp mill output will see a massive increase in tariffs. And so that will be a huge millstone around the neck for domestic manufacturers, which in turn will pull down some containerized freight volumes, because a substantial share of what comes in for containers is actually intermediate inputs the U.S. manufacturers use to produce other products.
Yeah, so final question here. We're talking a lot about tariffs. It seems that Trump and his advisors are convinced that tariffs are the way to go. Sort of an economist question. Do you think the tariffs actually work?
Nope, I can say that very strongly. They don't. There's numerous studies right now in economics. The most recent by David Autor and colleagues documents that industries that received protection from the Trump tariffs did not increase employment at all in response, but the industries targeted by China via retaliatory tariffs, especially agriculture, saw declines of employment. Separate research by the Federal Reserve Board has documented this. A good example that I would use for everybody is take production of steel in the United States. Steel production today is about 7% down from where it was in 2017. In 2018, it was about 3 or 4% higher than 2017. But then it fell in 2019 very sharply in response to declining machinery demand and whatnot, which was in large part due to retaliatory tariffs. The highest steel production in the United States this side of the global financial crisis was in 2011 through 2014 during the Obama administration, when there were no tariff protections in place, because we had such demand for machinery due to fracking, due to an agriculture boom, etc. Point being, tariffs, there's just no evidence that it is helping domestic manufacturers. And if anything, it typically hurts a lot of those industries, because if you're a steel mill and, other countries target John Deere farm equipment, well, that ultimately means less steel for you, because that means domestic production is down because our exports are down. So there's just no evidence that tariffs are a sound economic policy to stimulate domestic industries. And so my statement is maybe in certain specific instances, we do need to have conversations about dumping. But as an across-the-board, economic tool, they're incredibly ineffective.
So we know that the economists have some pretty significant questions about the likely effectiveness of a Trump tariff regime. And of course, we know that there is likely a pretty significant gap between any Trump election rhetoric and the reality of what he's going to be able to get through the US political system should he get in. But It's not a good sign that being bullish about Trumponomics means hoping that its most harmful parts are going to be ditched under duress. So what else should we be looking out for in shipping? Well, as ever, when trying to understand the intractable problems and unknowable conundrums facing shipping, I turn to the experts. In this case, I asked Greg Miller himself for a view.
Okay, so we heard Jason there give the economist view and talk about the likely pull forward of US containerized imports in 2025 should Trump win and go ahead with tariffs. But what are the other possible effects on containerized shipping from the presidential election? Greg, you're out there in the US right now writing about this day in, day out, talking to the people on a daily basis. What's your view?
Yeah, so Jason talked about the potential pull forward of U.S. imports next year due to the possibility of new Trump tariffs. I'd add a few points on containers. First of all, the effect of the U.S. import pull forward, really depends upon where we are in the broader market for spot rates. Spot rates now are currently extremely high due to the ton-mile upside from the Red Sea diversions. And so let's say Trump wins, the tariffs are implemented, the import pull forward effect really begins to ramp up next spring. We don't know that the Red Sea could be open by then, or it could still be closed. And meanwhile, we have this onslaught of new building capacity that's coming online. It's going to continue to come online through next year. And the consensus is that this new building capacity will ultimately overwhelm the Red Sea diversion upside, even if the Red Sea remains closed. So we don't know where rates are going to be next year, assuming U.S. imports do spike. It could be off a very low base. We just don't know. Another container issue related to the presidential election involves the ILA, the International Longshoremen's Association, the union that represents the dock workers at U.S. East and Gulf Coast ports. Their contract is expiring. They're threatening to strike. This wouldn't have anything to do with presidential politics if the contract expired on April 1st, but it doesn't. It expires on October 1st, which is just over a month prior to Election Day. The ILA is not communicating with the Biden administration now in terms of mediation. It's vowing to strike if its demands aren't met. It's using all this rah-rah American anti-foreign carrier rhetoric. So you can only imagine what the effect would be on sort of the tail end of the presidential elections. If U.S. East and Gulf Coast ports, which handle over half of U.S. imports, were to suddenly close a few weeks before Election Day. And I think that if that did happen, it would certainly have an effect on the view of the U.S. government, the next president, on foreign carriers in the next administration.
And obviously, as you say, this is the politicized bit. This is the visible bit. And when we talk about tariffs, we naturally think about containers. But looking at the other segments, how could a Trump administration affect tanker shipping, for example?
Yeah, on tanker shipping, one view is that it would be positive. A Trump victory would be positive for tankers. Trump likes oil and gas. Trump would be good for production. Thus, Trump election, good for tankers. The reality is that U.S. crude production and exports were at record levels during the Biden administration. In fact, exports were over 50% higher during the Biden years than during the Trump years. And also, the U.S. president does not determine U.S. production. That's determined by conditions of the field, the global price of oil, the business decisions of oil companies. And there's sort of a general sense that U.S. production won't be growing as fast in the future for structural reasons, no matter who the president is. On a more speculative level, there's another view that a Trump victory could be negative for tankers, particularly for tanker stocks, and this is related to geopolitics. There's this idea that Trump is friendlier with Putin and Russia. He's much less beholden to Ukraine and the EU, and that he could somehow force a resolution of the Russia-Ukraine war more quickly. And an end to the war, that war, would be bad for tanker stocks from a perception point of view. You can look at the container stocks right now. Every time there's a whiff of an Israel-Hamas ceasefire, container stocks sink because of the expectation that the Red Sea would reopen. So same thing with the Russia-Ukraine war and tanker stocks and the expectation of a loss of ton miles. But here again, I think the reality is more complicated. In the physical tanker market, it seems hard to believe that Europe would just suddenly revert to dependence on Russian crude and diesel all over again after everything that's just happened. I mean, there certainly is going to be some of that, but I think a lot of the ton mile upside could stay in place. And also to the extent that G7 and EU sanctions on Russia are reduced in the future, that really should theoretically lead to scrapping of a lot of the rust buckets that are out there, the dark fleet. And it should lead to more business for mainstream tankers in Russia. And so that would be a positive. And then just one final geopolitical point on tankers and Trump. Trump is viewed as more hawkish on Iran and more likely to do something sort of extreme there. So that's something you need to watch. What happens in the Strait of Hormuz? Any closure of that strait due to military action would be highly negative for tanker demand, simply because too much cargo would be shut in.
Indeed. I think there's a lot of people watching that space very carefully right now. But we've heard your view on containers. We've heard your view on tankers. What about dry bulk?
Dry bulk, during the Trump presidency in 2016 to 2020, U.S. dry bulk really took a beating, particularly U.S. crop exports due to retaliatory tariffs. The trade war then led to a real shift of Chinese sourcing towards Brazil, initially for soybeans, then for corn. That wasn't necessarily a bad thing from a dry bulk shipping ton mile perspective, because the voyage from Brazil to China is around 15% longer than from the U.S. Gulf. So not all bad there. And one other thing I'd bring up is that the situation is different now than it was then. If you remember back during the last trade war, China was in the midst of a severe outbreak of African swine flu. That decimated their hog population, reduced their import demand for goods like U.S. soybeans. There's no outbreak now, so China may have less flexibility if this was to happen all over again.
You've mentioned the big C word there a couple of times. The U.S.-China relationship, that's the big one, really. What's your view in terms of what a Trump presidency means in terms of that relationship and how that affects shipping overall?
Yeah, that really is the big one. I mean, the rhetoric on the Trump camp in particular is much, much, much more aggressive on China than the Biden administration or the Democratic Party in general. And this is the real risk to shipping demand. If there was ever shots fired between the U.S. and China in the South China Sea or anywhere over there, if an actual war were to break out during the next administration between the U.S. and China, there's the consensus out there now is that would be cataclysmic for shipping demand, whether it's containers or dry bulk or tankers or gas, whatever. Disruptions, as we've seen, are generally good for shipping rates, but there is such a thing as too big of a disruption. The Strait of Hormuz would be one of them. A U.S.-China conflict would certainly fall in this category. So we've talked about all this other stuff, tariff effect on U.S. container import volumes and timing, what would happen with the Russia-Ukraine war and ton-mile demand for tankers, and what's going on with U.S. energy production. Any positives from any of that would be overwhelmed if there was a conflict between U.S. and China. All the rest would be completely overshadowed. That's the kind of thing that's the kind of event that would pretty much trump everything else.
Well, that is where we're going to leave it this week. No doubt Trump and Vance will be cropping up again in the podcast in the near and possible midterm future, so fear not, there is more to come. For now, though, thank you to Jason and to Greg, and as ever, to you for listening. We will be back next week with more of the story shaping shipping. Thank you. Goodbye.